Welcome to Business Middle East. In this episode, we look at how currency trading is influenced by Federal Reserve meetings. And in Business Snapshot, we focus on Saudi Arabia's anger over Standard & Poor's rating cut. The Federal Reserve Bank continues to be indecisive over interest rates. After its latest meeting, the Fed kept the interest rate unchanged, which led the central banks of Japan and New Zealand to hold off on taking new stimulus measures. So the Fed maintaining monetary policies unchanged has an impact on currency trading trends in the Middle East and globally, particularly this time with the New Zealand dollar and the Japanese yen. Let's take a look at the story.
The Fed has once again left interest rates unchanged in October, and now attention is already on December's meeting. The central bank's overt reference to possibly raising rates in December caught investors by surprise, as did its failure to comment on troubles in overseas economies. Also notable by its absence was the usual mention of US labour market conditions. All this was interpreted positively by other central banks, particularly the Reserve Bank of New Zealand and the Bank of Japan. New Zealand kept rates on hold following the Fed statement, putting more pressure on the New Zealand dollar, as it wanted.
7% lower for 2016.
On Friday, the Bank of Japan kept the current policy unchanged, with no additional quantitative easing, which currently stands at 80 trillion yen annually. This has led to a notable rise in the yen against the dollar.
To shed more light on the currency trading trends, joining us is Noor Eldin Al-Hamari, Chief Market Strategist of ADS Securities. The negative data from the US was not unexpected, so why were investors surprised?
From our point of view, the main reason the Fed is insisting on raising rates this year is to defend its credibility. However, anyone looking at the economic releases since the beginning of the year knows that the economy is slowing down noticeably. If the Fed had been able to raise rates, as they noted in every single statement this year, they would have done it earlier. But now the estimates for a rate hike in December have increased significantly, simply because the Fed has mentioned the possibility of taking action in December. However, this note has been in the Fed's statement since the beginning of the year. There is nothing new in it. Therefore, we believe that it's better to wait for more evidence through the upcoming economic releases before deciding on such action. There are a few weeks left before that meeting in December, and the next few weeks will show whether the Fed will be able to raise the rates or hold them for longer.
After the central bank's decisions, how was currency trading, particularly in the Middle East?
The Fed's decision had a positive impact on the US dollar, as estimates for a rate hike in December have increased significantly. We noticed a high demand for the dollar from the Middle East through our trading platforms, leading to a significant decline in the New Zealand dollar and the Japanese yen. However, the US economic releases that came in after the Fed's decision did not help the US dollar, leading most of the currencies to recover losses incurred immediately after the Fed meeting. Therefore, the trading remains choppy and is likely to continue that way here in the Middle East amid ongoing uncertainty about the Fed's decisions.
This week we have the meeting of the Bank of England and the Reserve Bank of Australia. What's your forecast for the outcome of those meetings?
Our economic tracker for the UK and Australia shows that both economies are stable since the previous meetings. The economic releases are showing some sort of stabilisation. Moreover, the Fed's decision is likely to give both banks the ability to wait for longer before taking any action in the upcoming meetings. The Bank of England may hint at an earlier rate hike next year, which may support the British pound. As for the Reserve Bank of Australia, the latest decision by the People's Bank of China and the Fed statement is likely to help the bank to keep the current policy unchanged as well. If so, Australia is likely to keep the current trading range between 70 cents and 73 cents.
Thank you, Noor. Saudi Arabia has accused Standard & Poor's of not basing its ratings on facts, questioning the methodology it uses to make decisions. The agency has lowered its long-term credit rating for the kingdom by 1 point because its budget deficit has increased its dependency on oil revenues. More in Business Snapshot.
Saudi Arabia has criticised the decision by a leading credit rating agency to downgrade its debt, describing it as unjustified. Last week, Standard & Poor's cut its long-term rating by 1 notch to A+, citing a pronounced negative swing in the country's finances, which have been hit by falling oil prices. On Saturday, the Saudi finance minister called the assessment reactionary, insisting the economy remained fundamentally strong and pointing out that the world's 2 other major rating agencies view the country more positively. But S&P kept its outlook for the ratings negative amid concern about Saudi Arabia's ability to cope in the long term should oil prices remain low.
That's all for now. You can share your comments and suggestions via Euronews Business on Facebook. Thanks for watching. See you next week.